Existing home sales hit the highest peak since 2006. Things are out of control. Welcome to Housing Bubble 2.0 News of the Week, or as I like to call it, another episode of As the Housing Market Turns. Today is the 24th of January. Randy Patrick here, putting the realism back in real estate. Yeah, it's a Sunday. I wasn't able to do a video on the 22nd when NAR releases their existing housing data, so we'll do it today. Got a busy week coming up because things are happening in my housing market down here in Tampa, Florida. And I have a dilemma, so I want this video to come out today. My two favorite teams are playing at the same time. Clearly, the Buccaneers are playing, and of course, my Maple Leafs are playing hockey, believe it or not, at 4 p.m. So one starts at 3, one starts at 4. I don't know what to do. I have a dilemma. All right. Anyway, let's get into it today. Very interesting stuff. But first of all, if you're not already a subscriber to my channel, if you could smash that subscribe button, I would really appreciate that. Thank you. So we're going to look at, typically the existing home stuff. So NAR puts their information out every month. So we're talking about December 2020. Existing home sales in 2020 hit their highest point since 2006, but listings are at a record low. So of course, that is our issue. We've got pandemic-driven pandemic-driven demand, is causing lots of activity these days. So are low interest rates. People can't find homes. So guess what? Price points are increasing. That's what we're finding right now. Where will this take us in 2021? You can guess. I can guess as well too. But here's the scoop. I'm going to get right into some 5 hottest markets before I go through the NAR data. So this is kind of interesting. So basically we're looking at here, the most popular city for 2021 is Austin, Texas, according to a new report from Zillow, which surveyed a panel of economists and real estate experts. I'll get into the other ones in a second here, but basically the Sun Belt destinations are migration magnets, thanks to relatively affordable, family-sized homes, booming economies, and sunny weather, said Zillow's senior economist. So that's kind of great. So that's why we're seeing a lot of activity down here. People are migrating, people are relocating to different locations for various reasons. So basically the coronavirus pandemic has changed not only how we live, but where we live, and has upended some of the usual trends in housing markets. So according to Zillow, the hottest markets for 2021 are going to be Austin, Texas, Phoenix, Arizona, Nashville, Tennessee, Tampa, Florida, and Denver. Now, we know Austin's pretty booming. Phoenix is always expensive and leading the way, especially with Case-Shiller. Nashville, that's up and coming. My market's in Tampa. So everybody who I've spoken with in Tampa who maybe have not called me back or thought that they shouldn't invest might want to reconsider that right now, because I can tell you there's a lot of activity here. And I'm going to be making some big pushes to do stuff here in Tampa. Also Denver, Colorado. And yeah, sometimes we do see some conflicting data because, for example, Denver showed a net exodus of people with the U-Haul traffic. So it just depends on, who knows? Depends on statistics, whatever. But just so you're aware, Denver is one of the top markets, or what Zillow expects to be the hottest market, one of the top 5 hottest markets for 2021. On the flip side, we are looking at the markets likely to underperform, according to Zillow, are New York, of course, San Francisco, and Los Angeles. Now, the cool thing is that if you step back a bit, both these sort of, we'll call it market groups, have opportunity. So the ones that are hottest means people are relocating there, which means property values are probably going to rise, which means people are going to need to live in houses or rent accommodation. So therein lies opportunity. And on the other side, where we have underperforming, that means, for a period of time, you can probably buy cheaper, play the market a little better, and eventually people are going to come back to these markets if there's better pricing. So it really is just like called the shifting of metro bubbles and a reallocation of where people are coming and going across the U.S. In the end, it all kind of evens out. But the point, though, is that always buyers and always renters, people need accommodations. We're always lacking accommodation. Now, this is interesting here because as prices rise, affordability weakens, and more potential buyers are sidelined, the nation's home builders increased single-family housing starts by 12% month over month in December, according to the U.S. Census, but they are still far behind in keeping up demand. They're also hampered by rising costs for land, labor, and materials, which prevent them from putting up more affordable homes. So I've talked about this quite often. If builders could build them, they would do it. I mean, clearly, if they're increasing their build opportunities, They're just constrained by a number of issues, which is, as I said, land, labor, materials, of course. Now, this is interesting. The housing market has lost some momentum in early 2021, stated the chief economist for Realtor.com. We continue to see strong demand from home shoppers, but with shrinking number of homes, rising prices, and home selling quickly, the market continues to favor sellers. So it does. So clearly, it's a seller's market. That's always when there's then when there's more buyers than sellers. Sellers can name their price and create competition. Simple as that. But the point, though, is that we're seeing some momentum slowing down early in 2021. Also, discussions of potential increasing of interest rates, even though rates are going to still be affordable or very low. It does swing for refis and purchase applications when rates do change slightly. We've noticed that quite a bit. Now, in light of what I just said about lumber prices, spike in lumber and land prices causes homebuilder confidence to fall from epic high. So this is unique. So basically, confidence is two different things. We've got home builder confidence, and we have home buyer confidence. So home builder confidence, of course, has been up, but when they see lumber prices go up and land prices go up, suddenly it's like, okay, now our margins are tighter. It's going to cost more to build, cost more to develop, less land available. So home builder confidence in the market for single-family homes fell 3 points in January, according to the National Association of Home Builders / Wells Fargo Housing Market Index. Basically, sales expectations in the next 6 months fell 2 points, and buyer traffic fell 5 points. So that's kind of the scoop there. And really, if you take a look at this, it does make a difference because you've got land costs, development costs, material costs, skilled labor costs. So when everything rises, everybody wants affordable homes. And if you look at a lot of economists and analysts, they often say that if builders could build more homes, then we'd have our problem would be solved. Well, builders can't build more homes because of these constraints, and you don't build to lose money. And a lot of these builders are publicly traded companies, so they're not going to do silly things to put themselves at risk. So and that's why we have seen that the net or the median price, for a new construction home has gone up dramatically over the past couple of years. So just something to keep in mind. But limited inventory is also constraining robust growth, and a shortage of buildable lots is making it difficult to meet strong demand. And rising material prices are far outpacing increases in home prices, which in turn is harming housing affordability. So let's go to the bubble theory. Are we in a bubble? Sure we are, but are we in a housing crisis? We're in a housing affordability crisis. That's what's happening right now. So there's a lot of people on the sidelines waiting to buy, and trust me, the number one email I get from everybody out there is, I need to buy, but I don't know what to do. What should I do? Well, this is the problem, is that it looks like prices just keep inching up month over month. And people are getting priced out. People have what's called buyer fatigue, and people are getting tired of it, quite frankly. And right now, seems to be nothing here to curtail this issue with respect to housing. People, I'll call it the powers that be, still want this to move forward and increase. To the point where we're going to all be maxed out. So, one day home sales are going to slow down because people just are going to have enough and can't afford it. Simple as that. So let's talk about NAR. So NAR, National Association of Realtors, existing home sales. This will be, I should have said this earlier, this presentation will be a bit longer, so play me on 1.25 or 1.5 speed if you want. But really, we saw a 0.7 rise from November, but the annual sales increase is the highest since 2006. So really, it's the double-digit year-over-year growth, is the highest level since 2006, which is something else. Median home sales price is up to $398,000, up 12.9% from a year ago. Housing inventory sank to 1.07 million and a 1.9 month supply, both historic lows. So what we're seeing now is almost every month we're seeing records being set, either price points, sales activity. On the flip side, record low inventory, record low interest rates. So, when you take a look at, when you have one extreme and the second extreme, the combination makes it very difficult for people to purchase reasonably priced property. So I understand and I commiserate with what's going on. All right. So home sales rose in December, and for 2020 as a whole, we saw sales perform at the highest level since 2006, despite the pandemic, said Lawrence Yun, NAR's chief economist. What's even better is that this momentum is likely to carry into the new year, with more buyers expected to enter the market. So more buyers coming with even less property. That's not boding well for price points. I mean, again, as they said, if you're selling, great. But what are you going to do once you sell? You're going to go, buy something else at a high price point. Now, if we go look at the median price point, it's increases well too. The median, I guess you could say, existing home price for all housing types in December, 309,800, up 12.9% from the previous December. And housing inventory, again, down to 1.07 million units, which is down 16.4% from November and down 23% from 1 year ago. And, as we talk normally, in a normal year with no pandemic, November and December tend to be slower months just because Northeast, Midwest, you've got cold weather. It does affect people going out looking at homes. Also, with respect to, I guess you could say, Thanksgiving holiday, Christmas time holidays, stuff going on, that everyone's got your focus, they're not focused on housing, but now people are back focused on housing during these times because they know that if they don't go out these months, like in December, they're going to miss out, and it might be even more expensive than next month. So that's why we're seeing activity kind of increasing. And again, when you push, and we'll show you in a second, but when you push the information down, you can see where we had slowdowns, and this is picking up where we left off. It's kind of like we're making up for the missed months. So the Midwest remained unchanged, up 26.2% from a year ago, unchanged from the previous month. Existing homes in the South increased and up 20% from the previous time. Existing home sales in the West actually fell 1.4% from month to month, but we're up almost 18% from a year ago. So that's the scoop here. The Northeast climbed 4.5% for a monthly and was up 27.4% from a year ago. So lots of activity going on in specific parts of the country. So basically, year over year, all four regions increased in their sales volume. So here is the I guess the PowerPoint or the slides they produced. So we'll go through that right now. Existing home sales, seasonally annual rate of 6.76 million. We'll talk about that in a second here, what the seasonally annual rate, seasonally adjusted annual rate, because it's not really the true number of sales. They're basically just looking at the sales volume and extrapolating that over 12 months. So it's a bit misleading. Median price, we can see the line has gone up since 2016, and we're sort of peaks and valleys, but each time the valley is netting higher than the previous valley, and you can see where we are, 309,800. So up there. Existing home sales median price percent change year over year. So clearly from the far left is December 2019 and the far right's December 2020. We can see where the pandemic months showed some big slowdown in existing home sale median price changes. And it's gone really since August to where we are in December. So 5 months of double-digit year-over-year price changes. Slowed down a little bit from the October peak, but still, we're looking at double-digit price, year-over-year price changes, pretty significant to be that consistent for 5 months in a row. So there you go. Existing home sales percent year-over-year. Clearly, we can see where the pandemic had a not good effect on the real estate market. We lost 17. Well, we were down to hardly any growth in March, lost in April, lost in May, lost in June, kind of recovered a little bit in July and August, hit our 20% and above for September, October, November, and December. So, I look at when you take a look at the 4 months that we lost, look at the end of the year's 4 months, we pretty much gained it all back. So in the end, did we net out probably the same as last year? Pretty close as far as overall sales are concerned. This is the chart I always refer to in a number of my videos. It breaks down the market conditions. The dark or burnt orange, or whatever color you want to call that, dark rose versus light rose, is December 20. The lighter is December 19. So first-time home buyers, about the same from last year's market. Sales to investors actually dropped a little bit. Cash sales dropped a little bit. Distressed sales went from 2% to 1%, and days on market. So really, this is where competition heats up. So in December, 2019, average days on market prior to going under contract was 41 days, almost cut in half right there, 20 days less. So that's pretty significant with respect to people activity. So people are out there, And we know that it's a frenzy. We know that people are buying sight unseen. We know that people are overbidding for property. We know that people are actually, we'll say, walking away from terms and conditions. So they're waiving inspection contingencies and things like that. So that's why if it's a seller's market, it's a crazy seller's market. You can get your price and you can get your terms. Why not sell? You get a great opportunity here. But I want to, the red arrow there, just focus on distressed sales, which we'll talk about in a second. And that's not really changed. So distressed sales aren't hitting the market yet. Why? For obvious reasons, with foreclosure moratorium and some shutdowns. They will increase as time goes on. That's our opportunity right there. Home sales by region, clearly the South with 42% of the volume, Midwest next at 24%, West at 20%, Northeast at 14%. This seems to be a pretty consistent share of the pie as far as I'm concerned on a monthly basis. Now, housing supply at a national level, a green line condo, red line single family, blue line blended. We have seen that the market is just dropping with respect to supply level, and that of course manifests itself with competition and increase in prices. Simple as that. Sales by price range. Well, the sweet spot is that 250 to 500K range with 41% of the sales there. I look at the affordable housing range being 100 to 250K, 32%. The 0 to 100K, only 5%. Going up the other end, 500 to 715K accounted for 13% of the sales. 750 to 1 million, 4%. 1 million above, 5%. So that those two top, the 750 and above, we've seen those increase. I guess you could say it doesn't seem like much, but they've increased from 3 or 4 to 4 and 5 in the past couple of months because of the activity. And whether that's I guess you could say, are people leaving more expensive cities where their money is going farther in less expensive cities and locations? So even though $1 million sale may be expensive, comparatively speaking, from New York City to maybe Southeast Florida, you're getting more bang for your buck, for example. So that's just something to think about and how this distribution goes. Now, percent change in sales from a year ago by price range. So clearly you can see that the 0 to 100K range is actually losing. So there's basically very little sales and very little inventory in that range. The 100 to 250K, which is kind of your affordable housing range, only gained a little bit, and then you can see the 250K is gaining, the 500K is gaining, the 750K is gaining, the 1 million. Look at the difference in changing for the top tier. So more people are buying expensive properties. That may be skewing the market on a distribution side with the numbers, but it's still interesting. Now, if you look at this, and it does kind of skew. So this is existing single-family homes. So the first sort of chart grouping is percent change in sales from a year ago. You can see that the red arrow gives you the, was kind of what we just saw there, the percent and change across the sales segment. So you can see that in the Northeast, man, the 1 million sales are up 118%, but everything is up over 80% in the 1 million range across the board. Take a look at the 0 to 100K. It's negative. So less and less sales are happening in that range. Now, if you go to the next level, the 100 to 250K, not much, but you can see that the West has a lot less sales just because price points are much more expensive in the West. You're going to see less and less sales in that 100 to 250K range. Now, sales distribution, you can see the West having, or the 1 million, is increasing a little bit there. So it's just, it's sort of plotted along, but we can see where the sweet spot is. The 250 to 500Ks are majority of the volume goes. Days on market, look at the 100 to 250K range. Average is 13 days. It's amazing. Next average is 14 days, 19 days. So man. So that's median days, not average. But the point is, it's low, and you can see how that drives, down or drives up, I guess you could say frenzied activity and the need to make rash decisions, which is not always good. All right, hit this now here. The summary, up 12.9% year over year for $309,800. Median sales price. SARS, seasonally adjusted sales at 6.76 million. Up slightly from the previous month, up 22% from year over year. And our inventory down from 3 months worth of inventory the previous year to 1.9 months. A healthy market is around 6 months. That typically means there's enough properties, enough buyers coming in, enough people selling. It's a balanced market. So if 6 months is healthy, we are 33% of a healthy market right now. Think about that, which is unheard of. So every month we're hitting records, and not always are the records good records for the housing industry. Now, interesting here because, this came out as well, and this is a little bit of a synopsis on what we just talked about on a zero hedge here. Now, the existing home sales are what? They're referred to as, an unhealthy market, which I think is very interesting. So when we take a look at, the volume, you can see the V-shaped recovery here. I know the housing hap hikes authors and journalists out there. I already, saw some rhetoric about, the housing bubble bros are going to be, crying, in their position. But you know what? Whatever. What can I say? It's a controlled market. We all know that. When you don't have builders building as much, when you don't have distressed property hitting the market, it's artificially controlled. So let's give it a break, guys, and know that V-shaped recovery, is up there. And there's other things in the economy that are going on that maybe weren't, they're changing now. Funny enough that things, we had a new administration change, so stuff, again, I'm not gonna get into it, but it's just, we're gonna see stuff that maybe, spoken and told a little differently now. But the cool thing about it, so when you see that seasonally adjusted rate at 6.76 million, when you look though, it says for the full year, existing home sales climbed from 5.64 million up from 5.34 million each of the prior 2 years. So 6.76 million is the sales number, peaking in activity, peaking December, extrapolated over from that point on a 12-month basis. But in 2020, we didn't see 6.76 million homes sold. We saw 5.6.4 million. So just want to make sure you guys understand that it's a little bit different than how it's portrayed out there when they talk about seasonally adjusted. Now, interesting here though is that obviously the median selling price we just mentioned rose up 12.9%. According to Lawrence Yun, and so we don't always see his quotes all the time or in all the right spots. So here we see him saying homeowners are smiling because they're seeing price increases. He said on a call with reporters. This was not obviously out of the official NAR press release. Frustration is coming from the first-time home buyers who don't have any housing equity and they're trying to save up for a down payment. So yeah, people are having a hard time. Today's market is unhealthy. People are making hurried decisions and prices are rising way above income growth. What a unique statement. So when the chief economist from the National Association of Realtors is telling us that the market's unhealthy, why? Because prices are rising way above what normal income wage growth is going. That to me is a problem. Is it a bubble? I don't know. I mean, I think we know when Kay Schiller puts out their information that we see that we're hugely above the previous bubble. So, this is what I talk when I hear all the, where people's positions are, bubble, no bubble, who knows? I know what's going on in my market. I know how we're going to take advantage of it. I know what's going to happen in the next little while. So you either hop on board or you listen to the narrative that goes on right now. But, funny enough that, as I mentioned in some videos, we see some data that comes up from some of the data companies showing about the foreclosures and the potential volume there. We're now hearing more people coming out saying, well, we're not, it's unhealthy, this is very interesting. And this to me, it's a positive, it's not a spin, it's reality. It's positive that someone's actually saying this, especially the position that this person is in as the chief economist of NAR. And, you can have all the friends that you want, but in the end, it's going to hurt people. And if we had cheaper homes or more affordable homes, we'd actually have more people buying homes and life would be a lot better. They'd sell. But again, it is what it is. We'll just go from there. But and also sometimes people who don't say certain things, who are, I guess you say, remarkably absent during this, also read between the lines. That says a lot as well too. So that's kind of my perspective on things. And now this is interesting. So so this came out as well, and I want to talk about this because as much as everyone's asking, well, what platform do I have? My platform. I call it housing bubble because it's a housing bubble. We have one, and it's been brewing for quite some time, and it continues to grow. So bubbles do. The issue, we have it. So therefore, now we have an affordability crisis, and we have a controlled market that's being manipulated by the Fed and by the government, and lack of distressed property coming on board to provide some relief and some lower prices. So it is what it is. So we have to. I guess the point is, if you know it, realize it, work with it, and find workarounds to take advantage of the situation. So here's an opportunity here. So shortage of Greenwich homes triggers bidding wars, New Yorkers flock to suburbs. So basically, as we know, that the exodus of city dwellers from New York City continued until late 2020 as home buyers in Greenwich, Connecticut surged, according to Bloomberg. A new report from appraiser Miller Samuel Inc. and Douglas Elliman Real Estate said 317 single-family homes were listed in the tiny town located in southwestern Fairfield County at the end of December. A shortage of Greenwich homes prompted a fierce bidding war among buyers who were willing to pay at least 14% above the seller's asking price, compared to 2.6% in 2019. So that's pretty significant. So what we're seeing here is, that's why I call these like metro bubbles. So we're not seeing a national home price. We have a national home bubble, I guess you could call that, price bubble. But we're seeing, okay, we're going to have some slowdown and eventually some decreases, and we'll see some more inventory in, say, in New York City. But people who are selling, they're going, I'm going to get rid of my property, or I'm going to, or liquidate and go to other locations for different reasons. So that's why we're going to see some things change, and you've got other locations like a Greenwich going, okay, I'm in a little housing bubble now, and we're getting a pop. So it just depends on what's going on here. But my point to you guys is the fact that, this is where opportunities lie. So we can see that, time to sell remaining listings dropped to a record low. So, essentially the average listing time on homes for the market was 142 days compared with 183 days a year earlier. It's the fastest pace they've seen in 7 years in Greenwich. So interesting enough. And, a combination of the virus pandemic, social unrest, remote working, and violent crime has resulted in hundreds of thousands of people fleeing New York City. So they're going to go where? They're going to go to New Jersey. They're going to go to Florida. They're going to go to these other locations, and they're going to go north to Connecticut. It's really interesting because the Great Escape to Greenwich began in April and has continued ever since. Last month, we noted that condo interest in New York City suburbs was erupting in the fourth quarter, especially Greenwich. So people are even going, you know what? If I can't buy a single family, or maybe I can leave an apartment and buy a condo. So look at that. The pandemic home buying has ignited interest in suburban condos. So typically we always focus on single families, but it's interesting just to note that, maybe if you're used to apartment living in New York City, or the high price or whatever, hey, going to an apartment condo style living in Connecticut is the same, except cheaper, and now you can buy. So I think it's really interesting. New York City trend is to either downsize and find a house in the suburbs, or unload real estate and never return as the metro transform, into a violent hellhole. That's this article, all right? Well, anyway, so that's what's going on here. So, but let's think about this. So people are leaving New York going to Connecticut, which means what? Opportunity is knocking. So let's not sit here and complain about I can't buy a house or whatever. Let's look at it from what can we do to create an opportunity here, and how do I go back to this? And what my true platform is. Well, remember this when I was doing the foreclosure tour of America. Well, and I was looking around the greater New York area. Well, remember that Bridgeford, Stamford, Norwalk, Connecticut area, which actually Greenwich falls in that kind of metro. The FHA delinquencies as of November were 23.3%. Serious delinquencies are 17.2%, which to me means future problems, further problems now, but future problems down the road as that unravels. But when we take a look at, look at this, the pre-foreclosure little pay count I had here. So in Fairfield County, which, now granted, that's going to be all over the county, and Greenwich is probably the bottom left of the county. Greenwich I think is the closest to of that part of the county to New York City, and realize that this is just a bunch of red dots, but it doesn't show that. You may go, oh, they're all concentrated over in Bridgeport. Well, this is just, 25 or 50 of 1,391 pre-foreclosures. So this is where the opportunity lies. So if people are flocking to Greenwich, or they're going to go, okay, I like Greenwich, maybe I'll go to Stamford. Like you see, everything kind of morphs as once people get there. Well, you know what? Here's the opportunity right there. So either, you get involved in this and get involved in short sales and pick up some of these distressed properties, because retail buyers want to buy them, and that's the opportunity right there. So it just goes to show that when you see where the people are relocating, where the trends are going, I look at it going, match it up with an opportunity. So wherever there's exodus, or wherever there's people coming into the town, figure out what can you do to sort of get right in the middle of that and be the supplier. That's the whole point. It's almost like you're the pusher. It's like housing is a drug, because I think that's what's going on. Everybody's we're buying it, we're shooting it up like it's out of control, and you can be the pusher and be right in between. And that's not the best analogy, I would imagine, but still, the opportunities you can see. Get your hands on some distressed property, and retail buyers are going to want to sell this or sort of buy this from you. So it's an opportunity to make some income, flip properties. And why do I say this? Because I'm going to keep showing this so I can drive this home. Auction.com showing the fact that we're going to have 2.3 million, up to 2.3 million completed foreclosures by 2025. Well, it got revised to a bigger number here. Further adjusted to 2.5 million, 3 million foreclosures. And I just forgot about a slide I put in here, which actually shows even more. That'll be next video. So there you go, guys. Also adding 1.1 to 1.2 million delinquencies, not on any forbearance plans. So we're going to see a lot of stuff happening, as 2021 rolls through and 2022 hits, etc. So there will be opportunity here for everybody, but we just have to be patient. And again, according to the auction.com guys, short sales, other pre-foreclosure sales are poised to become a more dominant share of the distressed market in 2021 and beyond, right? So that is the good point here. So they're telling us what's going to happen, all right? We're seeing metro bubbles being created. We're seeing opportunity being created. We're being told that there's going to be foreclosures available out there. We're being told that this is a methodology to get your hands on them, either to primary residence or to become involved very easily in real estate investing, all right? As I say to people who I talk to, look for your primary residence, and along the way, you'll do investing on the side as a side hustle. Simple as that, all right? So, and this is the cool thing. So if I go back to one of the first slides of the hot market, so I'm in a hot market, or Tampa is a hot market, it'll be even hot market. So what are you doing in a hot market? Kind of like Tampa, Austin, kind of like we saw for Greenwich. Well, you find the distressed property. What do you do with it? You fix and flip it. You sell to retail buyers, or you make them rentals, because if it's hot markets, mean people are relocating there. So you're always going to have relocation that's going to need purchase properties, but also rental properties. Why? Because people are flocking to those locations. That's the whole scoop. So that is an opportunity. Now, what about the markets that aren't so hot? So we saw it was in New York, and we saw San Fran, LA. Well, you know what? Same thing. Find distressed property. Do fix and flip. Sell to retail buyers. So make them cash flow rentals, because they're cheaper prices now. People will flock back to these locations. Why? Because of the price adjustment. So what you do is you just adjust your price point. So if a cooler market means you'll be buying it a bit cheaper, which still means you'll have buyers, but you won't. It's all relative to the market at that time, which people I don't think really understand. So with distressed property, that's my whole point in my videos I'm talking about here, guys. 2 years worth of me yakking about this stuff boils down to, with distressed property, you typically are acquiring less than retail. So, which means it's all relative to the timing of the market. I know people, because I see it in the comments, I hear it and I see it in the emails when people I talk to, they say, I need to wait for material discounts before I buy. Well, you got to figure that out now. And I think there's more to it than just price point being lower. If you have lower interest rates and you can get some discounts on price points, you got to take a look at what's best for you and your family or your situation. The reason being, if you're looking to invest, that's a whole different ballgame. If you're looking to purchase a primary residence, well, if you're going to purchase a primary residence, you're not going to buy and sell within 2 years, because really that becomes an investment, right? That's taxable income, as opposed to what's protected with the IRS on your primary home sales. So that's kind of my point here, is that if you're waiting for material discounts, number one, that's kind of a fallacy. And if you're waiting to watch it, you're going to miss deals along the way, which is unfortunate. Also, when you may have, a lot of people have this material discount level they're looking for, and you don't know the level when it gets hit until it's after the fact, because realize that real estate is an after the fact statistical, we'll call it, industry. So we look at December housing in January. We look at Case-Shiller 2 months down the road. So we're not going to see when price points hit the bottom or where you need them to be until after the fact. And if that's the case, you may have missed that thing. Okay, it just makes you feel better. So the whole idea with distressed property is you're creating your own discounts. Now, this housing bubble is going to be different than the previous. And what I mean by that is, back in the last housing crisis, we had a surge of, we had price crashing because of tons of inventory. And then people realize I can buy this inventory. Well, now the people who realize they can buy it are ready to buy it. So we're not going to have this huge amount of inventory. We're going to have some of it. It's going to be good. But the point, though, is that there's always buyers, whether they are retail buyers, because we have more population where people want to buy. Low interest rates create the more buying opportunity for people. So if I have a home, I have the ability to, that I've got distressed, off market, whatever. Well, what can I do with it? Well, I can certainly sell it to a retail buyer because there's always retail buyers. Simple as that. I can always sell it to, depending on the price point, to a real estate investor or make it my own cash flow to make it a rental property. I can sell to a hedge fund, you know what I mean? So, or an institutional investor. So there's always buyers for property. And what it boils down to is, as I said, it's relative to the timing. So if I buy a property today, and for 100 and I sell it for 150, you know what? I'm making some decent money on that. So if properties drop in 6 months, if I buy for 80 in 6 months, I'll probably sell it for 120, 130. So you see, it's so the price you buy for and price you sell for, it's all going to, they're all attached. They all tag and drag along. So the point is, any time is a good time as long as you're getting in the distressed property market and you're buying with discounts in there. And how do you get discounts? Negotiation, leverage, timing, material defects of the property, seller issues, whatever. That's the whole point to this. But I always say the word, repetitive again and again and again. You don't have to wait. And I've actually seen some emails of people saying they're going to wait, and I'm thinking that's a bad mistake. Not a bad mistake, but you're missing opportunity. And when I just look, when I read this morning going, Tampa's going to be a hot market, I'm going to, one of my videos I'm going to put out is I'm going to call for investors. I need more investors, and I need, we'll call it funding partners, because I can run a lot of projects down here with funding partners who want to earn money, with buying and selling, fixing and flipping. As simple as that. So calling out people who want to connect with me. So there you go, guys. And that's the whole point to all this, I guess you could say. We know where the properties are, the distressed properties. You have to know where to look. And going back to that 1%, no one's working this market. As I keep telling everybody, 1% of all the on-market property sales fall into the distressed property category, which I just showed you based on the NAR information. That category is REO sales, which are foreclosed sales, foreclosed properties going back out in the MLS market, and short sales. No one is doing short sales. How do we know that? Go back to the 1% rule. So less than 1% are short sales. Real estate agents don't go after them. Real estate investors don't go after them. Therefore, that part of the distressed housing market where all these foreclosures are going to go or where they're available now, that's where you have to hit. That's the opportunity. Don't pass it up. Foreclosure filings are quietly increasing. More properties are being scheduled at the foreclosure auction. Go back to that 1% rule. The whole idea is to get a hold of these people before the auction and become a solution for them to buy them more time in the property, give them an elegant way to settle their debt, get out of the property, the proper transaction, as opposed to losing their home to a foreclosure, having a judgment follow them and collections going after them, and having to be evicted and having to scramble. What we do is a little different, helps people out in the end. All right, guys, I'll tell you more about it. Connect with me. There's my email. Looking forward to chatting. Hope you guys have a great day on Sunday. Watch some football. Take care. We'll talk to you early in the week.